everyone. I'm Megan Trask, Director of the Investment Committee here at CTWM, and I'm joined by my colleague John Shanley, our Assistant Director. We are just wrapping up the first quarter of 2022. It was probably not the start to the year that most of us would have hoped for, with both stock and bond markets down really across the board. But I thought it made sense to just take a pause and reflect on where we've come from, where we've been over the last couple of years. It was really just 2 years ago, March 2020, where the stock market was down 34%. We left the office, to work from home, thinking we'd be back in a couple of weeks, and didn't come back for a year, right? Folks lost their jobs. Folks were not spending money. We had a global shutdown, which sent, unbelievable shocks to the global economy. So, if you think about where we've been and where we are today, I think there are a lot of bright spots that are being underrepresented. If you look at how quickly our labor force recovered, we have incredibly low unemployment. People are working, wages are rising, and folks are spending the money that they're earning. You just look no further than Disney and Carnival Cruises reservations. They're having record bookings. So there is a lot that we can point to in the economy to say, wow, we're on pretty solid ground here. That being said, consumer sentiment is not particularly strong. Another way of saying that is people are worried, and there are some concerns out there. So we thought today we would highlight the 3 concerns that we're hearing most frequently from our clients, which I think also pretty accurately represent broader sentiment. So the first one we'll tackle, and I'll send it over to John to tackle, is we're hearing from our clients, I thought the bond part of our portfolio was the ballast. It's been a tough year for the bond market. Should we continue to hold bonds, and should we continue to think of them as the ballast of the portfolio?
Megan, I'll first say I think your broader point is so incredibly important. These 2 years, they've seemed like a decade, but we come out here, and I think especially in short-term periods where there's things that are very uncertain and there's volatility in different markets, perspective is so important. And what you'll hear from us a lot in every video and here today is understanding what's going on in the short term, but always focusing on the long term. And that's a perfect transition to the bond market today. I don't like the word historic all that often, but I do think what we've seen in the bond market this year can be considered historic. It's been an incredibly challenging start to the year for almost any part of the bond landscape. But there's a bright side to that. So as interest rates have risen, which have led to short-term price decreases in the bonds that you own, we now actually start to earn interest on our bonds. It's been 2 years since we've been able to get any type of interest rate on bonds. And today you can buy really high-quality, safer bonds for 3%, 4%. This time last year, those same bonds were yielding 1%, 2%. So again, the ride to get here has been a bit of a challenge. It's been like ripping off a Band-Aid in some sense. But we say with a lot of conviction, we have more belief and conviction and kind of belief in the future returns of our bonds today than we did, say, this time last year when interest rates were much lower. And I don't think we could talk about bonds or even the broader space, Megan, without talking about inflation. So share some thoughts on where we are with inflation today, and is it going to persist like we've seen?
Yes, that's probably one of the more common questions that we're getting, and rightfully or understandably so, given that's something we all probably see and feel every day. You just have to drive down, Route 4 here and look at the prices on, at the gas pumps, right? So the headline inflation number that we've seen has risen to 8%. So we're at 8% inflation. Interestingly, I think one thing to point out is that there are different categories behind that number. And if we look at the most recent inflation print, there are a couple of categories that are really the main drivers of that increasing headline number. Again, one being the prices at the gas pump, and it's we're all feeling that and we see that. But I think important to note there are other categories that our clients that make up a significant part of our clients' budget and our population's budget that are returning to more normalized inflation rates, things like medical costs and shelter. So I think just like everything in our finances, it really is, the impact to inflation varies between between individuals, and it's kind of a personalized impact and situation. So that's one perspective to think about. I think, another recurring theme, staying long term. The other point that I think is really important to consider with inflation is, literally our fight or flight responses in our brain are triggered when we see rising prices. And so it's human nature to want to do something to respond in the short term to those rising prices. However, the best thing, the most rational thing we can do is stay long term. We'd like to highlight a chart that you'll see come up here, which helps illustrate this point. If we think back to the 1980s, which was one of the last periods where we saw heightened inflation, and you were faced with an investment decision in 1980 with inflation at 10%, you could have gone a couple of different routes. What this chart is illustrating is a couple of different paths for investing $10,000 in 1980 when inflation was at 10%, and what the results would have been, at the end of 2021. The blue line is, at basically 100% stock investment. You can see incredible growth from stocks during that time period. The line right before under the light blue, the kind of dark bluish black line is a more balanced portfolio of stocks and bonds. Still, an extraordinary investment over the last couple of decades. What I think is really interesting to point out is the yellow line at the bottom, which is gold. If we think of this current quarter where we're seeing heightened inflation, gold has had a pretty good quarter along with other commodities. But when you look at the returns from that asset class over a longer period of time, not very good compared to a more balanced portfolio of stocks and bonds. So in trying to hedge against the short-term phenomenon, you can really impact the long-term growth of your portfolio. So we want to be really careful about that knee-jerk reaction to inflation. And so, again, that recurring theme of we really want to stay long-term focused, even though inflation is an issue right now.
One of the things too, Megan, I love about these charts is there has been a lot of times in this, since 1980 where there's been bad quarters and bad months and bad years and bad days, right? But when you have a long enough time frame, and all of us, I think, are investors that have year time frames, decade-long time frames, none of us should be making important life decisions on our portfolio based upon a 3-month time frame. So that's what I love about these charts, is really trying to give yourself perspective about the long term, and what does the long term really mean.
Absolutely. So the last question that we're hearing and we want to tackle with you today is a recession getting more close? Do we have to be worried about the U.S. economy entering a recession?
Yeah, so the recession talk has definitely come up more and more. One of the reasons that you'll sometimes hear for the recession talk is because of something called a yield curve inversion, which is just in its most simplistic form. There was the 2-year government bond at one point a couple of weeks back was yielding more than the 10-year government bond. In a normal environment, you'd expect to earn more on a 10-year bond than a 2-year bond. Historically, when a yield curve inversion has happened, that has led to a recession over the next 12 to 18 months. So that's a historical time frame. So there's kind of a couple different things we'd say. First off, that's an important point that we take in and understand. It's an important economic data point. But we also have to understand that the bond market today and the interest rate market today is quite a bit different than what it's been historically. There's a lot of intervention by the Federal Reserve in terms of what kind of the bond interest rates are doing. But I think there's an even more important point. We know, we can almost say with certainty, a recession will happen at some point, right? In a society like ours, in an economy like ours, there's going to be ups, there's going to be downs. But even though we know a recession is going to happen, it's almost impossible to predict when, and even more importantly, it wouldn't change our investment stances whatsoever. Part of being an investor is understanding that you're going to live through the ups and the downs, and trying to call those types of events is going to probably lead to more bad outcomes than good. There's a famous quote from Peter Lynch, who was a famous money manager for Fidelity back in the 80s, back in those recessionary times, and he used to say more money was lost trying to prepare for a market correction, rather than in the correction itself. So again, you might know all the data points, you might have an understanding of what these things mean historically, but more often than not, we truly believe the best thing is to stay invested. When you can find opportunities, take advantage of them, but always focus on the long term.
Very well said. I hope we were able to address some of the concerns that might be top of mind for you. If there's anything else, please don't hesitate to reach out to us, to your advisory team. And with that, happy spring, and we'll thank you for listening, and we'll talk to you more soon.
Take care.